So are we going to have a recession when the yield uninverts? Maybe, but maybe not. And if you stay until the end of the video, I'll tell you exactly why. So today is Friday, September 29th. Before I forget or even get into my video, do me a favor, give a thumbs up, like, subscribe, make some comments, say hello. Really helps me with the algorithm, and if you like the content I've been providing, it really helps the channel get out there a bit. So if you could do that for me, that would be awesome. So those of you who don't understand what people are referring to when they talk about a bond inversion, I'll explain that. And those of you who don't know me, my name is Adam Kahn, and I'm the Rational Investor. So, a traditional bond yield curve is going to pay more as you go further out in the timeline of the note you're buying. So, when we're talking about US Treasury notes, generally, if you have a 1 month Treasury, you're going to get a little bit less than a 3 month, which is a little bit less than a year, which is a little bit less than a 5 year, which is less than a 10 year, and less than a 30 year. When the curve inverts, the long end of the curve, meaning like the 10 year and the 30 year, actually pay lower interest rates than the shorter term. It's often an indication of maybe a recession coming down the line. It's showing that over 30 years, maybe you should be happy getting a lower rate of return than the shorter term. And generally, when that uninverts, it's a sign of a recession coming sooner than later. But I'm going to tell you why I don't think that's always the case, even though not a lot of people have this theory, and it's my own, which is why I like it so much. So I don't know if you guys will. But generally, when the yield uninverts, it's because the Fed is cutting rates, drawing the short term rates lower, which then re-invert the curve properly. Well, the Fed's usually cutting rates because they already see a recession beginning. And of course, that would be an indicator of a recession is here and that we're running into one. What I'll argue is we're slowly seeing the yield curve uninvert or getting a little flattened out without the Fed lowering rates. I think if you see the end of the curve, the further out dates, the 10 year and the 30 year, uninvert naturally, and we start to see higher returns on the 10 year and the 30 year without the Fed having to cut rates, then we don't have a recession. If the market can bear the rate increases the Fed's put in, and the curve starts to make more sense where further out dates get better return, means they see a robust economy and the economy pushing through it, and where the yield starts to make sense. If it's not because the Fed sees a recession coming and they need to cut the short end lower, which then reinverts the yield properly, but the long end just gets stronger and stronger naturally because of supply and demand reasons, I don't really think that indicates any recession. Pretty interesting, at least the way I see it. So it's really what I'm hoping for. I almost want the government to shut down and not come to an agreement, because if Moody's or Fitch lower the US rating, I think you could see that happen rather quickly. If we get downgraded again, the short end of the curve may not change that much because basically the way the short end works is more correlated to the Fed funds rate because that's the overnight lending rate. So if we get downgraded, people are going to see the bonds as being worth less and want more return for their investment because they see more risk investing in our treasury notes. I think that's really going to spike up the later dated yield, and you'll see the 10 year and 30 year maybe really spike from that stuff. I think it would be a really interesting scenario to see that happen. There'd be a ton of panic out there, and I think it could be a short term opportunity to buy some stocks. I'd be a little careful with some of the dividend stuff I've been recommending because as you can get better return in treasury notes, people won't be as excited about the returns in the stock market where they have more risk to it. Anyway, I think that would be really cool. I hate to hope for a government standstill and shutdown and them not coming to agreement. But to be fair, I think these idiots should get voted out of their positions because It's their job to do the right things by us. And I think that they stall to the last minute to for voting reasons and for people to think they've saved us or whatever else. I don't really like how the politicians play their games. They mess around with the regular person for their voting and what they think is going to work best for their party. I think if they go to a shutdown and cause some chaos, maybe they get voted out and we get new people in. I don't have much hope that they'll be any different. Seems to be the way the game's played. But I do think it could create some real opportunity. And I think the economy is doing better than a lot of the people on YouTube make it out to be. I think that things seem to be okay. Not everybody does wonderfully in normal economies. Some restaurants should go out of business from time to time, and it's a tough business. And other thing, I think the real estate being really slow, which is an industry I'm in and I love, but I think we had a big boom, and sometimes you need a long slowdown to shake that back out. Anyway, let me know what you think. I know it's a out of the box theory, but I think if we naturally uninvert, you might see the economy catch and do just fine. It'd be pretty interesting times. Do me a favor, don't forget thumbs up, like, subscribe. It really helps the algorithm. I would appreciate the help. Have a good day.